Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top business stories. Third straight day of gains on Dalal Street. Sensex up 433 points, led by IT, oil and gas, metals. Nifty above 15,800. Zomato plunges 6% after board approves acquisition of Blinkit Commerce. Food delivery platform set to acquire grocery startup Blinkit for 4,447 crores in an all-stock deal. Bajaj Auto board approves a buyback of up to 2,500 crore rupees at maximum price of 4,600 rupees per share via open market. Buyback price is a steep 20% premium to Monday's closing price of 3,855 rupees. M&M hits new all-time high on strong business outlook. Brokerages see up to 20% upside. Company also launches new Mahindra Scorpio-N 2022. In an exclusive conversation with Business Today TV, Maruti Suzuki Chairman R.C. Bhargava objects to Bharat NCAP draft norms notified by the Road Transport Ministry. Says car buyers should have the choice to choose their own technology level. Benchmarks extended gains for the third day in a row, aided by broad-based gains in IT, metal and capital goods stocks. Sensex was up over 430 points, shutting at about 53,161. Nifty rallying over 130 points, but failing to hold on to 15,900. IT companies and metals, some of the top gainers today. Broader markets mirroring the gain in those indices, with the Nifty mid-cap and small-cap headline gauges up about 1 to 2% each. ONGC, Coal India, L&T, HCL Tech, UPL, some of the top blue chip gainers in trade today, coming up for you on your screen there. Nice 3% jump up in ONGC, Coal India. On the other hand, Apollo Hospitals, Eicher Motors, HDFC Life, Kotak Bank and Britannia were some of the top laggards in trade. Our global business editor, Udayan Mukherjee, joining us now for a take on the markets and all the latest. Then what are you making of it? Last couple of sessions, we've seen some amount of stability. IT seems to be making a bit of a comeback as well. In fact, we've seen a pretty decent broad-based recovery so far, but it may be too early to tell.
Yes, Abha. I think this was on the cards because I think this fundamental starting point of this pullback that we've seen from around 15,300 to 15,900 is that there was just too much consensus pessimism on the market. You asked anybody last week, what's the market going to do? And there was almost a chorus of 14,000 Nifty which had built up. When there is so much consensus bearishness and almost a unanimity of view that the market's going to 14,000 next, the market is always likely to surprise and jerk you on the other side. And that's exactly what has happened. So I think a large part of the genesis of this pullback, of course, it helps that global markets have stabilized over the last few days, and there has been a pullback in the US market, and there has been a cooling down of the VIX in the US, the volatility index there. But that's also helped this rally. But I think there was just too much bearishness out here in India, which is not to say that that view should be dismissed and the market cannot go to those levels. But it was setting up the base for this kind of a pullback rally. What has also added to it, I suppose, is the fact that crude has had a 10% plus kind of a correction, which always helps sentiment in India. Monsoons have picked up a bit. Some of the recent economic data which has come in, the factory data, etc., has also been quite encouraging. So I think it's a mix of a few things fundamental, which is the economic data, the price of crude, etc. But I think a great part of that is because of the bearishness which had picked up, which had really peaked last week, for which this market had to give a snap pullback. And of course, the fact that global markets have also been supportive.
Okay. So are we still, however, tracking any signs of an impending recession, Udayan, or do you say that those fears or clouds have receded for the moment?
Which of us can say whether there will be a recession in the West or not? I mean, this is all conjecture. I mean, I'm no great global economist. Economists will make forecasts. We'll find out later whether it came down to a recession or not. I think it's safe to assume that economic conditions will remain quite sticky in the Western world for quite a few months from here on. How bad it gets, we'll see from here. Whether there are still risks in India of a further downside in the market, I think that risk is still open. But it's an evolving situation. At this point in time, one should not get too ahead of oneself about making predictions. I think it's an evolving bear market. Don't get too excited about the rallies. Don't get too despondent when the market slips off. This too will pass, whether it takes 6 months or 9 months or 12 months, we shall see. It's best to think about how one's portfolio needs to be tailored and how much cash one should be deploying on the declines. Those are more useful things to ponder over rather than thinking about great things like global recessions and whether they'll come about or not. Neelkanth, it's great to have you on the show today. You are no stranger to bear markets. Having seen so many over the decades, how bad do you think is this one going to get? I mean, by when do you think we'll start talking about the end of this one?
Udayan, as always, absolutely a pleasure talking to you. Thank you for having me on the show. We have seen the PE correction. As you know, the markets are driven by price to earnings and earnings. If you divide the market performance into how much have forward earnings changed and how much have price to earnings changed. So I think the price to earnings change in this cycle is more or less done. We could see another decline, and that's something I'll comment on briefly later. But I think the risk now, and I'm talking here at an APAC level, at a global level, is now the earnings changes, right? So as the global growth expectations now are steadily revised down, so everyone expects a growth downgrade. How severe that is as yet unknown. But the next leg for markets globally in Asia Pacific, and therefore by linkage to India, will be how much do we see the earnings fall by. And there I think the prospects don't look that good, in particular in sectors like IT and materials. Now, having said that, if you remember the 2000-2001 recession or the market downturn started off as deflation of a dot-com bubble. But then 9/11 happened and we saw further downside of the market. Similarly, in 2007-8, it was supposed to be the US real estate market correcting, but then Lehman went under and we saw a much bigger problem. So if it remains just a wind down of the fiscal and monetary stimulus, which turned out to be excessive in the US, and adjustment to the higher costs of energy because of the Russia-Ukraine conflict, then it should be fairly orderly. And in my sense, in my understanding, I think 6 to 9 months should suffice to get the adjustment going. But if this weakness in the economy exposes other problem areas in the global economy, then we could be in here for a longer time.
The feeling in the market from people one talks to, Neelkanth, though, is that this is a global problem. India is actually not in a bad place. Our macros are fine and we should actually get off fairly light compared to the rest of the world. Do you agree with that hypothesis? And can you recount or recall instances in the past where the world or the Western world, the US and Europe, have been in a bear market, but India has been in a bull market?
Yes, I think that can happen, though the probability of that happening at this stage would be low. To give you perspective, see, if you think about the Indian market here and the global market here, and this is the price to earnings premium, and think about an elastic band between the two, right? It is possible that, if we started here and the global market is falling off and this elastic is getting stretched, India can hold up, right? But beyond a point, it is very hard for the elastic band to stretch a lot, in the sense that our equity markets are totally open, in the sense that investors can come in and go out. Our capital account is totally open on that front. And therefore, global equity markets in many ways are deeply interconnected. What we also have to remember is that India is not yet an asset class. in the sense that a very large part of the equity capital that comes into our markets is through the emerging markets and Asia Pacific indices. So people invest in emerging markets. If the emerging markets asset class is not doing that well, then we will have problems as well. If the Asia Pacific markets are going to see a very significant impact of the downside risk on global goods demand, then I think the Indian markets will get affected as well. So I do think that we have to be wary of that. And remember that despite the decline that we have seen in our market so far, on a rolling 12 months basis, in dollar terms, we have outperformed the world by more than 20% in the last 12 months. So a lot of the resilience of the Indian economy and the fact that we didn't benefit that much from the global goods demand surge created by the US stimulus is something that I think the market may already be pricing in. So if more downside, if earnings downgrades in Asia, if second order risks in Asia pull down Asian markets more, then I think there is a risk that we get downgraded even more. We also see some downside risk. Having said that, because of the resilience of the Indian economy to what I think is going to be a problem for the world economy in the next 12 months, the forward earnings risk. So basically, if you assume that we did nothing for the next 6 months or 9 months, right? So to till end of FY23, the Nifty stayed at 15,500 or 16,000. On FY24 EPS, which will be the 1 year forward in March 23, we would be trading at sub 16 times forward earnings, and which is, I think, a fairly reasonable multiple to have, given that it was the low end of the range seen between 2015 and 2019. So some amount of time correction should get us to a place where the earnings growth after that will drive upside to our market. I think right now our P premiums to the world and to emerging markets are still very high. So if global markets come under stress, I think our markets won't be immune.
Neelkanth, what do you think we'll see when it comes to the demand, this whole dynamic play out and its resulting impact on the financial landscape? We're watching out next policy now. It's still a while away. In the middle, in the next 2-3 months, we may or may not see further surprises from the Fed. So we're not quite sure what to expect, but if we assume further tightening, how do you see this reflecting when it comes to the financials and whether or not they're likely to see the benefit of a changing rate scenario, or whether we'll still see certain challenges?
Right. So, see, the first thing is that if you're tracking nominal GDP, right? So when you're setting a monetary policy, looking at sufficiency of money, you need to look at nominal GDP. The nominal GDP in FY23 is most likely going to be within 3-4% of the pre-pandemic path. I'm not talking pre-pandemic level, I'm talking pre-pandemic path. So some normalization of monetary policy is something that was inevitable. If the economy is doing well, there's no reason for the MPC to say super accommodative. And therefore, 5.15, let's take another 25 basis points on that, because remember that before we went into COVID, the economy was actually decelerating. 5.4, 5.5 type of policy rate is just a reflection of the fact that the economy is now starting to normalize, right? What happens beyond that? Do we go to 6, 6.5? And my sense is that the global demand situation is weakening so rapidly, and especially in sectors like tech, where I think the new order flow is starting to look very weak, and order cancellations are starting. And so as that slows down the other economies, remember that the increase in exports from CY19 to CY21 in many of the Asian economies was 4 to 14% of their GDP. So the spillover of goods demand from the US and the excessive inventory building that the whole supply chain was doing is something that had boosted GDP a lot. And as those things start to correct, I think the necessity to keep raising rates may not be felt by the time we are in, say, October or December. Now, having said that, so what does this mean for financials? And I think that just the normalization, remember that credit growth is now at 13%. If back in July, August last year, when we started saying that it would reach these levels, people were wondering how can it do that, right? Because how will the GDP growth be sufficient? And our point was that as the GDP starts to normalize or come to the pre-pandemic path, I think the necessity of building inventory, so working capital is a very big source of credit demand. And just normalization of inventory levels in the economy will, I think, create credit demand. And that should be good for banks, for financial sector in general. And remember that the biggest fear in a down cycle is always for credit quality, right? So the PPOP, the pre-provision operating profits for the financial system is reasonably steady in India. Right? It could move between 10 to 15%. But the big volatility comes from the non-performing assets. And so far, the trading template that is being used by investors is still that if there is a growth downgrade, let me sort of be cautious on the banks. And we think that given that we are just coming out, we were starting to come out of it in 2019-20, but then we had COVID. So the banks are really well capitalized. I think the risk of significant credit quality issues emerging in India, at least, is quite low, and financials continues to be an overweight position for us.
All right, Neelkanth, thank you so much for joining us, taking out the time to share your views on all the latest developments from Udayan and myself. Great having you with us. Investors visibly unhappy with Zomato acquiring instant grocery delivery firm Blinkit. Shares of food delivery service tumbled over 6% in trade today. Price evaluations forked out to buy the loss-making quick commerce company are, of course, a cause for concern. But brokerages across the board seem bullish on Zomato. My colleague Sakshi Batra joining us with more on that. Sakshi, what are brokerages saying?
Well, that's right. Shares of Zomato fell over 6% intraday today after the acquisition announcement, reversing the early morning gains. So what really spooked the investors today? Well, analysts that we spoke to believe that there are many reasons for this. First of all, they believe the acquisition is at an aggressive valuation. Next, they believe that Blinkit is also a loss-making firm, which may only add on to more pressure on the financials of Zomato for the already cash-burning and loss-making business that Zomato has, and may further delay the operating profitability for Zomato going forward. Experts also believe that the grocery delivery business is a very competitive business and is unlikely to make money in the next 3 to 4 years, and therefore the decline that we've seen. Now, when we asked our analysts and experts as to how much downside do they really see for Zomato from here on, from the current levels, experts believe that there is limited downside from here as the stock is already down over 60% from its record high of 169 rupees seen back in November 2021. They believe the stock may not really breach its previous low of 50 rupees, but in the absence of earnings visibility, it may test anywhere between 55 to 60 levels. However, top global brokerage houses are still positive on this deal with Zomato and Blinkit. They believe Blinkit can actually help Zomato also, increase its TAM, make the business more defensible. They also believe the quick commerce space in the long run can actually help and complement the profit pool of Zomato, create synergies on the delivery costs as well. And therefore, these top global brokerage houses have a long-term target that's ranging anywhere between 80 rupees to 115 rupees on Zomato in the long run.
All right, thanks for that, Sakshi. Bajaj Auto approving the buyback of shares worth up to 2,500 crore rupees and 1.88% equity. The two-wheeler major intends to buy back 54.35 lakh shares via the open market. That's at 4,600 rupees per share. Now, this is after more than 2 decades that the company has announced plans to buy back shares. Street seemed unhappy with that decision. Share buybacks, according to analysts, typically improve earnings per share of a company and return surplus cash to shareholders, while also supporting the stock price during sluggish market conditions. In a big push to dominate the Indian SUV market, Mahindra & Mahindra launched a spruced-up version of the Scorpio. Christian, the Scorpio-N, the all-new SUV, is positioned above the existing Scorpio, which will continue selling in the market. Available in both petrol and diesel variants, the Scorpio-N has 5 trim levels and will be available in 6 and 7-seater versions. With the introduction of Scorpio-N and the recent launch of the XUV 700, Mahindra hopes to regain the crown of SUV king from Tata Motors, which captured the market with SUVs like Nexon, Punch and the Harrier. You will, however, have to wait a few months for the new car. Bookings open on 30th of July and deliveries will start in festive season. One of the biggest news over this weekend in the auto world was the approval of the draft notification of Bharat New Car Assessment Program, or the Bharat NCAP. What this is a new safety standard for cars which can carry 8 passengers. Each car will have to now be fitted with 6 airbags, a move being opposed by small car manufacturers like Maruti, who feel that the added measures will drive up costs considerably. In an exclusive interaction with Business Today TV, the company's chairman R.C. Bhargav said consumers should instead be given a choice on the matter.
What's your own reaction on this NCAP, and what does it mean for the Indian consumer and automakers like you?
You know, I'm all for road safety. But road safety must be looked at for all users of the road. Road safety is not only meant for people who can afford European cost cars. We have in India something like 230 to 250 million users of two-wheelers. Nobody in the world uses, well, maybe some people in Taiwan, uses two-wheelers to such a large extent as a means of personal transport. 2/3 of the petrol which is consumed in India is used by two-wheelers. So that will tell you the extent of use of two-wheelers. Now, there is no safety regulation of any kind for two-wheelers. If you look at the road accident deaths, about 30% of the deaths happen from two-wheeler owners. Nobody bothers about them. When we come to cars, even going to Euro 4, from Euro 4 to Euro 6, has what I mentioned just now, 28% decline. NCAP, Global NCAP, is an organization which is largely financially supported by makers of airbags. And the move to have airbags in the cars comes out of this NPAC and safer cars. Sure, cars should have safer cars, but give the customer an option. There are many cars today which are with 6 airbags and meet all the NCAP standards. If the customer really wants the safest of cars and can afford to pay for it, by all means he should get it. But if a customer has a choice of not having a car and buying a two-wheeler, or buying a car which doesn't have NCAP standards that meet the government standards, should he not have an option to buy that car, or should he go back to a two-wheeler which is much less safe?
Are you saying, therefore, that 6 airbags should not be mandatory?
I'm saying that NCAP should not be mandatory. I'm saying that India is a different market from Europe. We cannot follow the European standards of safety in all the vehicles in India because we can't apply that to two-wheelers. And are we going to leave those people out of the safety thing and only apply safety standards for the more rich people? Surely we should look at what should be done to provide better transport for the people who use two-wheelers.
So why is this being done, sir? Why is this being done?
Because it's the global, what's happening in many countries today. Although even today, the global NCAP is not mandatory in anywhere in the country. It's an option which customers get to buy cars, and the manufacturer sees which cars the customer will buy or what standards. India, that option is not there.
And that's where we leave it on the show tonight. Thanks so much for watching.